Okay, let's dive right into this rapid review explainer. We are going to completely hack those tricky CFA Level 1 bond classification questions. If you've been staring at endless lists of fixed income securities and just feeling totally overwhelmed, well, you are in the exact right place. We're going to strip away all that extra noise. We'll use these visual breakdowns to give you a true structural understanding of how bonds actually work so you can just dominate on exam day.
So, we are going to attack this material systematically today. First, cracking the bond contract, then government versus corporate, coupon and principal structures, embedded options, the interest rate risk table, and finally, an exam day attack strategy. Let's get right to it.
All right, part one, cracking the bond contract. Before we look at any specific bonds, we really need a fundamental mindset shift.
Take a look at this quote. It says, understanding bond types is less about memorizing a list and more about understanding the contractual design. That is absolutely crucial. You aren't just memorizing a dictionary here, right? You are learning how a machine works based on its contractual design. Once you understand the gears, who issues it, how it pays, what special features it has, you can look at literally any bond on the exam and instantly figure out its risk and return profile.
Moving on to part two, government versus corporate. First up in our structural blueprint, we've got to look at the manufacturer of the bond, which is the issuer.
Now check out the stark contrast between your two major players here. Over on the left, we've got sovereign bonds. These are issued by national governments, like U.S. Treasuries, for example. And they are considered to have the absolute lowest credit risk in their local currency. Why is that? Well, because they are backed by the taxing power of the government. Literally, if they need money to pay you back, they just tax the citizens. Simple as that. But on the right, corporate bonds, that is a completely different animal. They rely purely on the company's ability to generate earnings. Bottom line, no profits, no payout. And this whole dynamic builds a complete spectrum of credit risk. Up at the very top, you have your ultra-safe U.S. Treasuries. Just below that, non-sovereign governments. So think of your local state or city municipal bonds. Then we have quasi-government agencies like Fannie Mae, which are kind of government adjacent. Finally, we hit the corporate sector, which itself is basically split right down the middle. You've got investment grade for your stable, low-risk companies, and high yield, which you'll often hear called speculative or junk bonds for companies where the default risk is noticeably higher, but hey, so is the potential reward.
All right, part three, coupon and principal structures. Now we examine the actual engine of the bond, how and when you actually get paid.
We'll start with the most basic engine out there, the fixed rate bond. The coupon remains completely constant throughout the entire life of the bond. This is your standard, plain vanilla structure. I mean, if it pays 5% in year 1, it's going to pay 5% in year 10. It's totally predictable. But the flip side is that it leaves you exposed if market interest rates suddenly shoot up. Then we have this really fascinating variation, zero coupon bonds. With these, you get absolutely no periodic interest payments along the way, nothing. Instead, your entire return is based on a discount mechanism. You buy the bond today for, say, $80, and at maturity, the issuer pays you the full face value of $100. Over time, the bond naturally pulls to par. You buy it cheap, you wait, and you collect the whole shebang at the very end. But what if inflation is your absolute biggest fear? Enter inflation-linked bonds, which are often called linkers. Look at how this works. The most common type, like USTIPS, actually adjusts the principal amount based on inflation. The fixed coupon rate is then applied to that newly adjusted, higher principal. So if you're worried about your purchasing power eroding over, say, a 10-year hold, these are definitely your best friend because the engine itself adapts to inflation. And finally, for our coupon structures, we have floating rate notes, or FRNs. Instead of a fixed payment, the coupon on an FRN basically rides the wave of current market reference rates. It pays a base rate, like SOFR or Euribor, plus a specific spread. If market rates go up, well, your coupon payment goes up right along with them. And actually, this brilliantly illustrates a massive CFA tip you absolutely need to remember. Floating rate notes carry vastly lower interest rate risk, which is often measured as duration, compared to fixed rate bonds. Because their payments automatically adapt to the current market, the bond's price doesn't have to violently swing up or down to compensate for changing interest rates. The coupon basically does all the heavy lifting for you. Okay, moving to part 4, embedded options. Let's look at the custom upgrades that can dramatically alter a bond's valuation and risk profile. First up is the callable bond. This means the issuer has the right to call or buy back the bond from you before it even matures. Think of this as a refinancing refund policy for the issuer. If interest rates drop globally, the issuer can just call your bond, pay you off early, and issue new debt at the new lower rates. For the issuer, it is fantastic protection. But for you, the investor, not so much. It limits your upside potential and introduces reinvestment risk, because now you've got cash in hand that you have to somehow reinvest in a much lower rate environment.
Now, the exact opposite of that is the puttable bond. Here, the power is completely in your hands. The investor has the right to sell the bond back to the issuer at a pre-specified price. So, contrary to the call option, think of this as your personal satisfaction guarantee return policy. It protects you if interest rates rise sharply or if the issuer's credit quality suddenly takes a nosedive. If things start looking bad, you just put the bond right back to them and get your money out.
Our third embedded option is the convertible bond, and this one is a true hybrid security. The bondholder can actually exchange the bond for a specified number of the company's common shares. This option basically acts as a VIP equity upgrade. You get the safety of regular bond payments, but it allows you to participate in the company's upside if their stock price suddenly takes off to the moon. Part 5. The Interest Rate Risk Table. We have reached the climax of our explainer.
If you take away literally just one thing from this session, let it be this ultimate cheat sheet for your exam. Seriously, memorize this relationship. It elegantly ties together the features we just discussed with their specific impacts on risk and yield. Notice how a callable bond has higher interest rate risk due to price compression. Because it limits your upside as an investor, the yield is inherently higher. Basically, you demand a premium for taking on that call risk. On the flip side, a puttable bond has lower risk because of your exit option, which means you accept a lower yield. Essentially, you are paying for that downside protection.
Let's quickly isolate the extremes here to really cement your understanding. Look at floating rate versus zero coupon. Floating rates offer very low interest rate risk because the yield is variable. It just adjusts to the market. But zero coupon bonds, because you don't get a single penny until the very final maturity date, they represent the absolute highest interest rate risk for their specific time frame. Every single ounce of your return is locked up at the end, making the current price incredibly sensitive to any rate changes. And finally, Part 6, Exam Day Attack Strategy. Let's wrap this up with a tactical approach for when you sit down on exam day and face a massive wall of text. Look, whenever you face a bond types question, don't panic. Just look at the prompt and systematically ask yourself these 3 vital questions to instantly diagnose the risk profile. Number 1, who is the issuer? That immediately tells you the credit risk. Number 2, how is the coupon calculated? That zeroes you right in on the interest rate risk. And number 3, is there an embedded option? That alerts you to valuation changes and price volatility. Honestly, if you break the complex question down into these 3 simple mechanical parts, the right answer is always going to reveal itself.
All right, I'm going to leave you with this provocative thought to really test your new mastery before exam day. Consider this scenario. If a bond combines the highest interest rate risk with a variable yield, what structure are you looking at? Think carefully about how those gears fit together, or actually if they even can fit together based on what we just learned today. Trust the system and you are for sure going to crush those fixed income questions. Keep learning, and I'll catch you in the next explainer.